Something historic happened this month, and I haven't seen anybody talk about it. It is a move we have never seen in modern market history. Now, the S&P 500 rose for 5 straight days, gained about 1%, while the VIX, Wall Street's fear gauge, also climbed more than a full point. And that combination has never occurred before. For 35 years, rising stocks and rising fear have been like oil and water. One goes up, the other goes down. And this month, that changed. Now, this isn't just a quirky data point. I believe it's a flashing signal that something deeper is changing in how the market behaves. You see, the VIX has always been known as the fear gauge. It stands for the Volatility Index. It's kind of like a barometer of investor anxiety, only it measures volatility only on the downside, meaning if stocks rise very quickly, even though that is technically volatile, it does not spike the VIX. Now, normally when investors buy put options to protect themselves from losses, you'll see the VIX rise. And when markets are calm and climbing, those fears fade. Volatility retreats. The VIX goes down. But not this time. Stocks are surging and the fear gauge is spiking. And all of this happened before Trump's announcement of placing new tariffs on China that caused the market to fall. So what is actually happening beneath the surface is kind of like this big tug of war between optimism and this unspoken but hidden unease. Now, what I see happening now is not traders hedging, they are chasing. So instead of buying puts for protection, they're doing just the opposite. They're buying call options in record numbers. Option volume is hitting all-time highs, more than 40 million contracts traded daily as investors scramble to bet on more upside. Now, this is not just the usual risk management. This is FOMO-driven speculation. And when that kind of behavior dominates the market, volatility itself starts getting a bit warped. Prices rise because traders want them to, not necessarily because the fundamentals justify it. And this kind of call mania can distort the market. You see, call options are like leverage on steroids. And when investors pile into them, the market makers, the guys selling these options, are forced to then hedge the above average action of those positions by buying the underlying stock. And so that mechanical buying pressures prices to rise even higher. So it kind of like creates this feedback loop. Momentum is essentially feeding on itself, but this kind of self-enforcing rally also breeds fragility. And when the music stops, even small shakeouts can trigger big violent swings. And that, I believe, is why we're seeing such big reactions. I don't think the bull market is over. In fact, all of the indicators point to us going higher, but we are getting into that sort of mania phase of the bull market. And when you have stocks that are up 2, 3, 4, 500%, when you have an index that's up 30, 40% over the last 6 months, everyone's a bit on edge. They know this is better than normal. They know it shouldn't be this good. And so any chink in the armor, any little weakness, they're going to panic and dump. And so what we're beginning to see is where a down day in gold used to be, 0.5%, now it's 2 or 3. A bad day in the index used to be 0.5%, 1%. Now it's 2 and 3 and 4% because everyone's going, is this the thing? Is this the end? And so volatility is being driven by excitement, not by fear as it traditionally is. So the VIX is rising not because investors are panicking, but because they're too optimistic. And speculation has hit such extreme levels that even a minor dip can cause these big reactions. Now, there is a hidden gap out there, and that is the one between realized and implied volatility. So all volatility is not created equal, all right? So realized volatility is how much the market actually moves. Implied volatility, which is a figure that is priced into what determines how expensive or cheap an option is how much traders expect it to move. So right now, stocks appear calm. The charts look steady. But the cost of protection, what it costs you to buy those puts, is quietly rising. And so even though there's not a lot of actual volatility, the implied volatility is driving up the prices of these options. So traders essentially don't trust the calm. And they are bracing for a storm even as prices continue to melt higher. And this divergence is a pretty classic sign when there is unease in the market. So the market is basically smiling on the outside, but sweating underneath, right? Now, here's what's important. We are in October, and this is historically the most unpredictable month of the year. I know, not what you want to hear. Over the last century, volatility, if you look at a month-to-month basis, in October runs 33% higher than any other month. So, and a lot of the reasons for this are known, like the big funds are doing their rebalancing, portfolio managers are repositioning, corporate earnings start coming in. But this is when markets tend to kind of snap out of complacency. If the calm cracks, it usually happens now. Now, what history tells us is pretty interesting. And when you look back over the last 100 years of data, October the 26th has historically marked the Q4 low for the S&P 500 index. For the NASDAQ, it's October 27th. It's like right there. So these late October dips have often served as launch pads for these powerful year-end rallies. So it's kind of like a head fake when we're in the first half of October. Everyone freaks out, they're panicking, and then it just shoots off from there. And that brings us kind of here, which is a market that just feels a bit strange. So we have record call buying, we have record speculation, we have gold and real estate and stocks and crypto, for the most part, all near their highs. But we also have a very volatile month, the most volatile month of the year, colliding all at once. The market isn't fearful, but it's not overly confident either. It's kind of driven by momentum, by positioning, not by clarity or high conviction. So is a crash coming? I do not believe yet, no. But make no mistake, this is not normal. Momentum remains a dominant force, and until it breaks, the path of least resistance is still going to be higher. I'm riding the wave. I would advise people to do the same, but no, it is being powered by a lot of leverage, a lot of speculation, not necessarily by fundamentals. Now, it is my belief that this will eventually lead to a market crash. It happened after the 90s dot-com bubble. It happened after the real estate boom of 05, 06, 07. It happened after the big rally post-COVID. It's likely to happen again. It has continuously happened over the centuries, is going to continue to do so. Do I think it's coming next week? No, but this is going to be an ugly one. Now, the counter argument to that is, Ross, you don't understand AI. This is revolutionary. It's going to greatly increase our efficiency, drive costs way, way, way down. In fact, we might be undervaluing AI. And listen, that could be. But the most dangerous sentence in investing is as follows: this time is different. Now, I encourage you to subscribe to this channel. We're going to stay on top of this. I will be sure to notify all of our viewers when we do see the market cracking. As of now, it is gas on the pedal. Momentum is moving higher. Markets continue to be strong. And if that changes, obviously, I will let you know.